Hi, Larry Gaines, Power Cycle Trading. So in this video I want to show you a directional trade setup that's very defined risk using a butterfly strategy. So I like to trade the markets kind of on a swing trade basis, 1 or 2, 3, 4 days kind of a duration in a really high volatility market. The shorter duration trades are probably the best way to go because the longer you're in a trade, the more potential risk for something to happen. So on this trade we've been watching Facebook. It's been a really nice downtrending channel, you can see, but then we noticed this week, actually kind of starting last week, it started to directionally push to the upside. So we're starting to see positive momentum here on our indicator cycle 1 and 2. That gives us price direction. And then it started to approach into this down channel and looked like it was going to potentially break. There was a lot of option activity going on. So we set up right here on Monday the 10th, we set up a butterfly. We were looking for a low risk trade setup. And so what we did, we were looking for this target area here, which is a kind of a measured move Fibonacci level at 144, 145, but being such a kind of a short distance to it and the potential for it to move higher, we elected to do what we call a ratio butterfly, or kind of what I call a ninja butterfly, targeting this kind of 145 level. And so we use puts in order to create this butterfly structure. So let me show you the trade setup. So we're targeting the this target at about 145 right here, this fib level, a little bit over that, up into potentially 148. So we set up a put ratio butterfly targeting the 145. You can see it right here. So the ratio is a 147 put, buying the 145, and then selling two more 145, buying the 143. So it's a 1 by 3 by 2 ratio, and that's why it's called a ratio butterfly and using put. So put ratio butterfly. Set this up at 98 cents, so that's the credit received. Now, the beauty of this type of strategy is if Facebook into expiration on this Friday the 14th was to go at 147 or higher, we still keep the 48 bucks. Not 48, but the $98 credit if it was to explode up here. So with a regular balanced butterfly, this would be probably a losing trade. So we keep that. Now, if it was to go out exactly at our strike price, that body of the spread, the target of 145, theoretically this trade would make $298. And the risk on this trade is the difference of $2 wide spread less 98, so we've got $102 at risk. So great risk reward. Takes advantage of theta decay, implied volatility collapse. Just one of my favorite trades. And right now you can see it's currently at a 24-cent credit, so it's up $73 or about almost 70% on your risk of 100. Hope this helps. Talk to you on the next video update.